With more than 6,000 small and microcap companies listed, if you're looking for the next apple at the earliest stage, then channelchek truly is the orchard. The listed companies support channelchek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for channelchek so you're always up to date on what's going on at the small and microcap data place. Welcome to this special edition of the C-Suite series presented by channelchek and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on channelchek. This Uranium Power Players Investor Forum presentation features GoviEx Uranium, OTC ticker symbol GVXXF, TSXV ticker symbol GXU. Following a brief overview presentation from CEO Daniel Major, Noble Senior Research Analyst Michael Heim will moderate a Q&A session. With that, I am pleased to present Daniel Major.
Hi, my name is Daniel Major. I'm the CEO of GoviEx Uranium. I'd like to take this opportunity to give you an overview of our company, what we're doing in the uranium market, and where our projects are in Africa. As in all presentations, we just have to deal with the initial disclaimers and cautionary statements and respect that there may be some forward-looking statements made during this presentation. So GoviEx is a very straightforward story. We are a very Africa-focused uranium company. We are focused on the development of our projects. One of our key and outstanding points is that we have two projects and they are both mine permitted and have therefore met the regulatory requirements to allow them to go into development and production. We spend a lot of time simplifying those designs, getting them ready for final feasibility study. The next steps are moving forward, certainly on the Madaouela Project, to the financing stage, the offtake agreements. We've been in this business in Africa since 2007. We have an exceptionally large mineral resource. But despite that, given the areas of ground we have a lot of exploration upside with several drill-ready targets out there. We have a third project as well, much more of an exploration play, an interesting polymetallic with uranium, copper, gold, and silver, all inherently associated with that project. So that's the brief overview. Just an overview of myself. I am a mining engineer by trade. I started my career working for Rio Tinto at their Rossing uranium mine. Since then, I've worked around the world in different continents, working in gold, manganese, molybdenum, pulp and paper. And I've also spent time as a rated equity analyst for JP Morgan and HSBC. So we have a whole board that's very much focused on development with a lot of experience in doing it. So as I said earlier, we are very much an Africa-focused entity. We started in Niger. Niger has been a substantial producer of uranium since the early 1970s. And in fact, it accounts for about 60 to 70% of that country's annual exports, predominantly coming from the two Arana-Areva mines of Comanak and Somaïr. It's had a mining code that hasn't changed since 2006, so substantial experience there. And I recently had the pleasure of going to the Somaïr mine. The standards that you will see there are similar to you would see in Canada, North America, and or South Africa and Australia. So top-class operation. We're also down in Zambia, a country known for its mining industry, particularly with the copper belt. And then lastly, Mali, while a relatively new entrant, has very quickly become Africa's fourth largest gold producer, with again a very standard OHADA ECOWAS approach to mining legislation. Some comments briefly on the uranium market, and I appreciate that this event there are other people presenting on the market as well, so I'll keep this short and sweet. It is really driven effectively at the moment by strong growth coming out of developing Asia reactor builds, particularly driven by China and India, who are on strong development paths. So we're looking at about 3% growth. With the change in focus around the world and an increasing focus on the emissions of carbon, we're starting to see major developed nations like the US, Japan, Canada, all committing to very strong reductions in greenhouse emissions. And it's clearly become obvious to most people that this cannot be achieved just by renewables, and that nuclear has got to be part of it. So we're looking at a very strong growth going forward. There are new aspects coming through, much a longer term, the development of the small modular reactors in the 10 megawatt to 300 megawatt rather than the 1300 megawatt size, which are starting to come in. Very much a focus for Africa and part of the new development for places like the UK and the US of A. In addition, hydrogen is becoming a major play. Nuclear is finding its footing in that area, and its ability to reduce costs and create capacity, very much part of that. And then lastly, an increasing notice that we've got to get shipping into the green market. And obviously nuclear has already been part of shipping, with aircraft carriers and submarines and icebreakers already using nuclear energy. So these are new areas we expect to see nuclear energy growing its position that are not part of the current trend defined. On the demand side, we've had a major change in the market. Last year, over 185 million pounds of uranium was consumed, but only 120 million pounds was mined from the ground. The rest was being filled by secondary markets. Half of that was for inventory drawdown by the utilities, the other from secondary sources. And herein is one of the issues that, as we look forward, forecast by UX Consulting, are that those inventory drawdowns effectively in the next 10 years will have gone, and will have seen a decline in secondary supplies. So over that time, secondary supplies will have reduced in total 45 million pounds in the next 8 years. So effectively, you're looking at 3 cigar lakes, 3 large mines disappearing. At the same time, Cigar Lake itself is expected to close. So we've got a very large supply deficit building there. You would expect the industry to be able to fill that. However, if prices for uranium do not go up, new mines will not get built, and the price will have to go up to fill that gap. And this is something that the utilities understand. They appreciate that prices are going to go up. There is a supply deficit. They are constrained by their current balance sheets, and many of them are trying to still consume inventory to support their balance sheets. But this can't go on for much longer, particularly in the US of A, whereas from 2024, they're effectively uncovered. They do not know where the uranium is going to come from to meet their requirements, and they're going to have to fill those. So there is this impending gap that has to be filled, and that is effectively what we see as the driver for prices, and why we're already starting to see uranium prices pick up. And GoviEx fits into this beautifully. We are a development company. We're focused on getting our projects up and going. We start with the Madaouela Project in Niger. Once that's going in commercial, we'll bring on the Mutanga Project in Zambia, and then the exploration for Falea will follow on thereafter. We'll start with Madaouela. It's a straightforward project. It's in the middle of the Sahara Desert. As my friend the camel indicates, it's pretty barren up there. But despite being in a fairly barren area, we are directly next to the towns at Arlot and Akukan. These towns have got about 200,000 people in total living there, and they were built for the mines of Somaya and Cominac. So all of the infrastructure is there. There's roads, there's power, there's water, and there's people who are already trained and skilled at mining uranium. And in fact, the Cominac mine closed this year in March. So there's people ready to come into development of new mines in the country. Water, as I said, is substantial in the area, and we're doing a lot of work to reduce our consumption of it planned going forward. We recently put out a pre-feasibility study at the beginning of this year. We've already taken it into final feasibility. That final feasibility study is expected to be completed by May of next year. We're currently looking at a project that will produce about 2.5 million pounds of uranium per annum for up to 20 years, and potentially a lot longer with the exploration upside. Madaouela is one of the lowest cost producing projects planned for Africa, given its high grades and the molybdenum credits that come with it. We're already working with the government. The government of Niger is a 20% shareholder in our project. 10% of that is free carry, 10% of that is not free carry. As I said at the beginning, this is fully mine permitted. It had its environmental impact assessment done. So we're fast tracking that feasibility study. We're now working on the financing side of it, particularly the debt side. We've already appointed people in the company to start working on the offtake structuring for this project. So we're hoping by the end of next year, we will have all of those stages in place that we can start construction going into 2023. The other project we have is Mutanga. This is a very straightforward open pit heap leach operation in the southern part of the country. It's based on a number of deposits with a lot of exploration upside between them. We own 100% of this one. Zambia is interesting insofar as the country is very committed to diversification of its commodities. It's currently very focused on copper and would like to get uranium mining. Zambia is also one of 13 to 14 countries in Africa who have an active program to go nuclear. And so having a uranium mine in their country is a very key component of that push to become a nuclear nation. At Mutanga, this is probably the lowest capital intensive project in Africa. As I said, it's a very simple project, benefits from very low stripping ratios and very low acid consumptions. Currently, it's about an 11-year mine life, producing again about 2.5 million pounds per annum consistently across that time frame. Again, exploration upside, potentially pushing that project out to a longer time frame. And then the third project we have is Falea. This is currently got about a 30 million pound uranium resource. It comes with credits for copper at about 0.2% copper and about 70 gram a ton for silver. We have 3 licenses here. The far right-hand one with the numbers 2 and number 4 is our Medini license. This one, because of its geology, will have no uranium in it, but we have realized it's part of a wider gold trend in the region. It's not our intention to get into gold development, but we realize it has value, so we have been doing relatively low-cost work on it to prove up the gold potential for other gold producers in the region from a transactional point of view. But what we have been doing more recently was work on IP, induced polarization surveys, which have shown that below the uranium project that we already have, which is in the bottom left-hand one, you see that black line from the yellow circle. That's the flat planar uranium deposit, are these underlying IP targets. The current target is over 2 kilometers in length, and it's obviously the potential import of where the copper, the silver, and the gold and the uranium coming from, and represents for us a future exploration opportunity going forward. As I said at the beginning, we have a very experienced board, a lot of experience in and technical and costs. Benoit Lassalle was the founder of Semafo Gold, has a lot of experience in West Africa and continues to operate in that region through a number of different vehicles that he's the CEO or a director of. David Cates brings his considerable experience in uranium through Denison Mines. Chris Wallace experience in debt. Salma has a lot of experience as a banker and currently running businesses in West Africa. And Everett Kraft brings a lot of skills as a financier into our operation as well. So a very extensive board with a lot of experience. We've got strong sponsors, a strong capital structure. The last set of financials, we were sitting with about $10 million of cash. We have a debt on the balance sheet. This is due to the Niger government, but it's actually not payable until July of next year. And that was part of a transaction where they cancelled a large debt that we owed them in the past. And that cash is enough to keep us going well into next year. From a value proposition, if you looked at the previous cycles, whether it was the 2004 to 2007 cycle or the 2011, Africa has been a great place for investors to make a lot of money. In the first of those 2 cycles, the 07 cycle, the real driving force were companies like Paladin, Energy Fuels, where they got massive re-rates from going from developers to being producers. They de-risked. And obviously that's exactly where GoviEx is with its mine permitted projects looking to become a producer. In the second of those cycles, there were no new projects built, but what you had was the takeout, particularly in Africa, of permitted projects. The most obvious of that being extract, which the Chinese turned into the Husab mine, where control of large uranium projects ready for development was the key for the major uranium producers around the world. So in GoviEx, you've got both of those potential. At the moment, we're massively undervalued versus our peers. And in fact, on the Australian peers, they're already trading at their NPVs, where the other jurisdictions, Africa, Canada, are trading at discounts to their net present value. So a lot of value to be had in the GoviEx share price, a lot of upside. So just to complete where we are, we believe in the uranium market. We see that strengthening over this rest of this year, particularly with the new Sprott Uranium Fund. Back to the utilities, we certainly expect to see increased buying as their inventories are coming back down, and they recognize this problem they've got from 2024 onwards with uncovered positions. We've got this strong board. We've got a lot of exploration upside, but with a big resource. But the key focus are these two permitted projects that are ready for development in Niger and Zambia. And we're already working on finalizing those studies and working on the financing, particularly of the Madaouela Project in Niger. So I'd like to thank you at this point for listening to my presentation. I hope I've given the company the credit it deserves for the projects we've got there. And at this point, I will turn it over to Michael for questions. Thank you very much.
Daniel, thank you for the presentation. I'm going to start out with a general question. You're a little bit different from some of the other presenters, and then you've got assets in Africa, which I see is actually an advantage given the increase in demand we're seeing in Asia. What's the latest you're hearing in terms of restart of nuclear plants in Japan or new construction in India or China?
Well, let's start with China, because they've been very clear on what they're trying to do with their massive growth rate coming through. So what was it, last year, 48 gigawatts. By the end of 2025, they want to be at 70. By 2030, they're looking at 120 gigawatts of power. You're seeing steady announcements on those pouring concrete or getting approval. So I think at the moment, when you look at China, it's very clear they're moving forward on their stages. Very similar with India. They're behind the curve on where they are with where China is, but certainly going in the right direction. Japan continues, I think, to be something of a, we're not quite sure what they're doing. You know, they have to go through a very rigorous process. I think what was interesting is that the government continues to have a plan to get back to 20%. During this very hot summer, they were forced to restart reactors that they weren't intending to restart at this time. So there is a very clear position there that reactors are needed and they're going to have to put them on. I expect, I think we're 9 running there at the moment, expect that a slow and steady approach from Japan on reactor restarts, as it is clear that they're going to need them going forward, and they have the commitments. Yeah, it just takes longer in Japan. They have a very much a process of involving the community in those restarts, and it's become quite legalistic as well, but expect those restarts to continue.
All right, I want you to walk me through kind of the timeline on things. I thought I heard you say that you're looking to have a definitive feasibility study in Niger next March, or did you say May?
I said May, yep.
And at the same time, you kind of said that you have several drill-ready projects in both Niger and Zambia. Are those kind of on hold till after the feasibility study, or just kind of walk me through what the next steps are?
Yeah, I mean, what happened with our projects, just kind of give you a background, is, you know, once we had got clearly projects with 20-year life and an 11-year life, when the uranium market went down, there was no real point in continuing to explore, because, you know, if you can't make a project that's 20 years in life work, there's no point in making it 40 years in life. And so we effectively put a block on all the exploration beyond that point and said, look, you know, we'll go back to that as and when we need it. And therefore, yes, it is 20-year life in Niger, but expect it to probably last longer, or we have the optionality of going forward. From a timeline point of view, certainly in Niger, the plan is at the moment that by the end of May, we would get the feasibility finalized. At that point, we will then already be engaged in the process of starting to see where we can get to on the financing of it. The pre-feasibility study showed that about 50% of the project capital could be done by debt, based on a $55 uranium price. So, we've kind of timelined ourselves and said, look, from May until the end of the year, that's probably a reasonable time frame to expect to be able to pull together all of the due diligence the lenders and the off-takers want, to be able to go through that whole process and structure the financing for it, and at the same time to be able to pull those off-take contracts in that's needed to be done. What is very clear when you talk to the utilities is that you have to be able to prove your viability. They're not going to just sign contracts just because you say you can sell them something. They want to know that you're going to be able to deliver it. So, we see 7 months, we'd start earlier than just waiting for the document. There'll be a lot of pre-education in this. So we see next year as that sort of time frame, and reckon by the end of next year, everything will be in place to literally kick off the construction phase.
Let's get into the financing just a little bit more. I want to make sure I got the numbers right. In Niger, we're talking, did I see a $347 million number? You just said that maybe
that's correct.
50%.
That's right.
Debt, and some of that could be covered by offtake agreements. But you've also said that you want to move from being a developer to a producer. How big a chunk do you think of the equity portion do you think GoviEx could take on?
Well, I think GoviEx is going to have to either come in with a partner who comes in at the project level or the corporate level to finance it, or we will have to raise that equity. Obviously, as part of the feasibility study, I'm again trying to push the capital number down. We pushed it down from the last pre-feasibility to this one. And again, we're very focused on trying to push it down even further. We go into an incredible amount of detail on these, even on the pre-fees. We're almost at feasibility study level from the work that we're doing. So, I think a 50-50 equity. The thing with the offtake is, you're not just looking at prepaid offtake structures. You're also looking at fixed price contracts to underpin the debt side. The debt side is very conservative. It will find any risks that it can to try and justify downplaying their risk profile. And so therefore, certainly with the offtake agreements, you're trying to underpin that price where they would like to say, well, we want to put in a lower price. And you say, well, you can't, because we have agreements out here that have it priced between this price and this price. You really can't put it at a lower price than that.
Talk to me a little bit about your relationship with Denison. You've got a board member. Do they own some of your stock as well?
Yeah, no, they do. They're sitting with about just under 14% of the company. The reason Denison is there is that back in 2016, I think back at the end of 2015, they acquired Rockgate, which was a company, if you remember back then, had the Falea Project. Denison effectively wanted the cash that was in Rockgate at the time. We wanted the project. So we approached them and said, look, you're really after the cash. Why don't you, and you want to focus on your Canadian projects, why don't we take all of the African projects off you, which is Zambia and Mutanga and Falea. So we did that deal for paper back then. It was a very good deal for us, because they effectively, I think we paid them $3 million worth of paper, and they gave us $1.2 million of cash to help fund the runway for at least a year. So that's really where their stake comes from going forward. But we do have a very good relationship with Denison. We're able to leverage off, quite a lot of stuff that they do.
We've talked a little bit about the Niger project. Kind of walk me through the timeline and expectations with the Zambia project.
Yeah, Zambia, we kind of got it running about 2 years behind. Obviously, I don't want to try and build two mines at exactly the same time. It's a little too stressful. So effectively, we're currently in a program. We've just done a program of infill drilling. We'll continue on the main deposit, Dibwe East. See, when the thing was originally permitted, there were 4 deposits, and 5th deposit was added, which was Dibwe East, a much bigger one. So we're doing the infill drilling that will push into next year with the MET work, and then you're effectively just going then into final feasibility study the year after that. So, sometime around the end of 2023, you'd be looking at final feasibility study on that project. and then looking at financing it. But by then, obviously, we would hope to have Madaouela up, running, producing cash flow, which just makes that process easier.
So it sounds like everything's just about 1 year behind the
yeah,
first.
it's kind of 2 years. It's a 2-year construction phase. So I wouldn't want to start constructing one until I finish the other one.
Okay.
But, you know, Zambia is a nice one. It's a really simple project. You know, it is just a very simple open pit heap leach operation. So it's an easier one to probably build out of the two.
I read somewhere that the Mutanga project had its permits revoked and then reinstated with conditions. Can you just explain what was going on there?
Yeah, the Mutanga project actually has 3 mining permits, just a kind of idiosyncrasy of how it built up. So 2 of them we acquired from Denison under Mutanga. The third one was acquired from a company called Africa Energy at the time. That was the far right-hand ones on the presentation, Guava and Nyame, the licenses. And the ministry back at the beginning of last year decided that cadastre was overly full. Literally, there was nothing left to permit in the country pretty well. And so they cleared out something like 850 licenses in a day. They literally just put a stamp out and said, look, all these projects that haven't gone into construction or we've got no exploration reports up, the licenses are revoked. And they gave an option to appeal, which we did. And we just went back to them and said, look, you know, we hear you. We obviously couldn't build a mine. Here's the reason why the mine never got built, because this thing was permitted back in 2009. And as soon as it was permitted, the uranium price, by the time they were ready to start building, the uranium price just crashed. And we highlighted the fact that we'd substantially increased the size of the project and substantially reduced its costs. And as a result, we just said, look, you know, we're in a much better position, expect the uranium market to recover. And they gave us the permit back. All they've really asked is commitments from us to actually get on with the job, which is effectively what I've described to you just now, pretty well within the scope of what we've said, is that, yeah, would you please now start moving forward because you expect the uranium price to recover. And that's the business plan we have them. And with the new change in president, we would certainly expect to see that continued support from the government, particularly as they're very much more focused on trying to get the mines underpinning the economy.
You mentioned some debt to the government coming due next July. I also read about some area taxes, like $6 million that might be due.
Yeah, it
was the same issue.
It's the same issue. We have an area tax. When we did a deal with the government where we cancelled $14.5 million that we owed them for the 10% stake, and it was a function of purchase prices and area taxes at that point. And we went to them back and said, look, you know, we need to come to an agreement of how to make this. And I think it's a positive. I mean, it just shows the government very pragmatic. They just said, look, you know, yeah, we'd love the cash, but the reality, we'd very much prefer to have a uranium mine out there instead. And we do not expect you, when uranium's down at $20 a pound, to be able to raise the $14 million in the equity market. So we'll take the stake and you can buy it off us once you're in production. So, you know, that was a very positive statement. They also agreed at the time that the area taxes would be deferred for a period of time. And so that's effectively what it is. That is the area tax payments that are due to the government in July of next year.
Do you have enough cash on hand to last you through next July, or do you think you'll need to do some type of?
No, our burn rate's obviously gone up because, you know, the uranium market's gone up, so we're having to work a lot harder. So no, we will have to raise some money by June of next year. Obviously, we will also try and negotiate with the government as well on that position and see what we could do. The intention was always that it would be financed out of the project financing. So obviously that's we have a new president as well in Niger, and we will approach him and see if they're interested in coming back to the negotiating table to see if that's possible.
I want a little clarification on a comment you made. You said that the utilities have not been signing long-term contracts, which we all know, and you said because they are balance sheet constrained. Can you just expand on that a little bit?
So yeah, some of these guys out there, particularly, you know, when you look at a lot of the utilities in the US, their margins are very low and have been struggling, you know, hence the reason why Exelon is threatening to close down Byron and Dresden. simply because they just don't have the margins they need to hold those balance sheets in position. And don't forget, the balance sheet includes these large uranium stockpiles that they were buying. I mean, they had too much material on their books and needed to reduce those positions. So a large part of what you've been seeing at the moment has been utility drawdown of what they're going. And a lot of the feedback we get from the buyers is, they know they've got to pay higher prices, but when they go back within their corporate structures, they're going, well, that's the price that's out there. We don't expect you to see more. There are some as well that have come out of Chapter 11 or have structures that provide subsidies, where clearly they cannot be seen to be paying high price contracts to secure material in the future. They have very much got to work in the spot market and deal with the lowest price they can get. So, that's kind of where a lot of them, there are bigger ones who can take a much bigger position, and obviously some of the major utilities out there are able to take a much longer term. But, utilities, as you know, come in many shapes and sizes.
So I'm going to close on another general question. You did a good explanation of the supply and demand and why uranium prices are probably going to rise, and we hear that story a lot, obviously.
Yeah,
that story's kind of been there for 5 years. Why have we not started to see the rise yet?
I think as an industry, we had not appreciated the amount of inventory that was actually out there, and I think that is fundamentally the problem. And even now, when you look at any other industry, when you were consuming 180 and you're mining 120, you would say, wow, this should be just flying. But the reality is we've had many forms of inventory out there that needed to be worked through. And I think the biggest one that we really, as an industry, didn't get a handle on, because this industry is not the most, transparent of everything volume-wise that's out there. But the first one was the underfeeding problem that was out there, where you had material being put through for their own book. The enrichers were using up their capacity and creating material that they didn't really need. And so that EUP product was being basically sold off cheap because they didn't want to store it because it's exceedingly expensive to store. And therefore, there was a lot of material being created. And if you buy EUP, you don't need to buy U3O8. So effectively, that was the market that needed to clear out first of all. Once that had cleared out, and you saw that once that EUP price started to climb away, it was very clear there was not a lot of that. You then needed the conversion market to sort itself out, which you suddenly saw when the conversion margins went from $4 up to $22. So we cleared out the next part of the pipeline. The last part of this pipeline has always been what the utilities are currently holding themselves and needed to be cleared away. And you've seen that over the last few years, particularly the Europeans and the US have seen inventory drawdowns. Europe's always a bit more awkward because, of course, the Germans have been steadily closing reactors at the same time, so they haven't needed to. But you've seen Euratom particularly coming out and saying, guys, there is going to be this problem going forward. You need to diversify your goals. You need to think about where your uncovered contracts. And I think that's the other message that I would put back out there, which is very supportive for companies like ourselves. The utilities don't like having just two major suppliers. They are desperately looking for diversification in the industry that allows them to secure metal, particularly, as one of those suppliers has got a mine shutting at the end of the decade, and the other one has an influence by a foreign power over it as well. So yeah, long answer to your short question there, but yeah, inventory. But that inventory is as I said in that slide deck, you can see now those inventories are just disappearing, and we now need new supply to fill the gap.
I lied. I'm going to sneak in another question or two. You're kind of, as we talk about the utilities unable or not unwilling to sign long-term contracts as long as spot is at the price it's at, it kind of describes to me a situation when spot starts to move that they may be scrambling to then start locking in. Is that how you see things eventually moving, that it could be in more of a spike format instead of slowly going up?
Yes, I think there is that potential as they all come into the scrummage. It will come, and the way I look at contracts as well is they're a risk-reward balance system. At the end of the day, we all sign contracts to protect ourselves for risk. That whether it's a utility or it's a producer, that's what long-term contracts are there for, because you're pinning in prices. And obviously the utilities want to pin it in so they don't have to pay too much, and we're putting them in so we don't have to sell too cheap. And so it just needs that incentive price to get there where all the parties say, yeah, it's now in the best of both worlds. We're both going to feel some pain here. Let's lock it in. It's not there yet. And and as the presentation and most of the guys in my industry will say, there's very few companies, in fact, there's almost no projects out there that can really get away at under $50. Or if there are, they've got a long permitting pipeline in front of them still and probably won't turn up for another 10 years anyway. There is in the problem. So, if you're the US guys, about 50% of their book is uncovered in 2024. By 2026, it's 70% of their book. So they are going to get a lot more desperate and say, well, where am I going to get my material from? I'm going to have to sign these contracts because, if you're still going to need, 190 million pounds, 200 million pounds, but still only 120 million pounds being mined, I better start incentivizing some projects to get built here so I can get my material. And the only way to do that is to give them the prices that they need. I mean, the most obvious one being MacArthur River. Cameco shut it down because they said they needed prices. And at some point, the utilities will have to incentivize Cameco to restart MacArthur River. And the only way they're going to do that is to offer them the prices that they need to restart MacArthur River.
So this really will be my last question. You talked about 120 billion and the gap. And I guess the question is, why aren't there more people doing what you're doing, at the exploratory or the developmental stage? We hear a lot of talk, but nobody's moving forward. It seems like everyone's just waiting for the price to go.
Yeah, I mean, I think we're all exactly, you look at my peers, we're all trying to get ourselves ready to go in various stages. In the last cycle, there were 500 utilities out there, 500 companies in uranium exploration. A couple of years ago, we were down to 50. I think we're now back up to about 60, almost 70. So we're starting to see new players turn up, some older projects being rehashed and coming through, but that price is still the constraint. We're all trying to get ourselves ready to go. It's a long lead time on all of these projects, but we all still need that uranium market price and those contracts to underpin it. You won't get the debt unless you can underpin. The debt market is very conservative, and project financing debt, as you probably know, is even more conservative than most debt. And they're going to want to see a price underpin, particularly where you see the uranium price having come from. Anyone who's not part of our industry, if you're on the credit committee of the bank, you'll say, well, why won't it go back to the last 5 years? Well, we all have the arguments of why it won't do that, but that's why those contracts are key to what we do.
Terrific. Well, there's been a very interesting discussion, and appreciate the chance to learn a little bit more about your company and for our viewers to learn more as well. Thank you again for participating in our conference.
Thank you very much, Michael. Appreciate the time, and I certainly appreciate those questions.
Thank you for joining us for this C-Suite interview presentation brought to you by ChannelChek. Visit our YouTube channel for more interview content, as well as virtual roadshows and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and microcap companies listed.